Ever dreamed of turning a modest investment into a mountain of wealth? You're not alone. But beware, the path to financial freedom is littered with pitfalls that trap unsuspecting beginners, causing them to lose money as quickly as they hope to gain it. Mistake number 1. Not understanding what you're investing in. Imagine you're at a market and someone offers you a magic bean that they claim will grow into a huge treasure overnight. You might be tempted to buy it, right? But if you don't really know what the magic bean is, you're taking a big risk. It might just be a regular bean after all. This is similar to investing in something you don't understand, like complex financial products or trendy stocks mentioned on social media. Many beginners lose money because they jump into investments on a friend's tip or a hot tip from the internet without really understanding what they're putting their money into. For example, investing in penny stocks or cryptocurrencies. Just because you heard someone made a huge profit overnight can be akin to gambling. These investments are often highly volatile, and their value can skyrocket or plummet quickly. The key to successful investing is knowledge. Before you invest in anything, take the time to learn about it. What does the company do? What are the risks? If you can't explain your investment in simple terms to a friend, you probably shouldn't be putting your money into it. Always remember, understanding what you're investing in is the first step towards making informed and profitable investment choices. Mistake number 2. Failing to diversify. Imagine you have 10 apples and you put all of them in one basket. If that basket falls or breaks, you could lose all your apples in one go. This is similar to investing all your money in one company or type of investment. If that company fails or the investment goes bad, you could lose all your money just like those apples. Diversification means spreading your investments across different types of assets, like stocks, bonds, and real estate, or investing in different companies and industries. It's like putting your apples in several different baskets. If one basket falls, you won't lose all your apples because they are spread out. For example, if you invest only in technology stocks and the tech sector suddenly drops, your entire investment could suffer. However, if you have investments in other sectors like healthcare, energy, or consumer goods, these might not be affected by the tech sector's downfall, or they might even gain value when tech is losing, balancing out your losses. By diversifying, you reduce the risk of losing a significant amount of money from a single unexpected downturn. It's a crucial strategy for protecting your investments and ensuring steadier returns over time. Mistake number 3. Trying to time the market. Imagine you're trying to jump onto a moving merry-go-round. If you try to jump on at the exact moment it's closest to you, you might land perfectly, or you could miss and fall. This is similar to trying to time the stock market, where investors attempt to buy stocks at their lowest prices and sell them at their highest. It sounds easy, but it's extremely difficult to predict these moments accurately. Many beginners think they can predict the stock market's highs and lows, but this often leads to making rushed decisions based on emotions like fear or greed, rather than logic and research. For instance, you might panic and sell your stocks when their prices drop suddenly, fearing they will drop even lower. But if the market recovers quickly, you've sold at a loss instead of waiting for a potential gain. The truth is, even professional traders with years of experience and advanced tools struggle to time the market consistently. A smarter strategy is to invest regularly, regardless of whether the market is up or down. This approach, known as dollar cost averaging, reduces the risk of making poor investment decisions based on short-term market fluctuations and can lead to better long-term results. Mistake number 4. Overreacting to market volatility. Imagine you're on a boat in the ocean and suddenly the water gets choppy. If you panic and jump off the boat every time a wave hits, you'll end up in the water instead of reaching your destination. Similarly, the stock market naturally has ups and downs, or volatility. New investors often panic when they see their investment values drop and may sell their stocks in fear, usually at a loss. But just like weathering the storm on a boat, the key to success in investing is to stay calm and stay on course. Over time, the market generally trends upward, so maintaining your investments through the rough patches is often more rewarding than trying to escape them. Mistake number 5. Ignoring investment costs and fees. Think about buying a car. If you focus only on the sticker price without considering maintenance costs, taxes, and insurance, you could end up spending much more than you planned. Investing is similar. Many beginners overlook the costs associated with investments, such as management fees, transaction fees, and fund expense ratios. These fees may seem small individually, but over time they can significantly reduce your investment returns. For example, a 1% annual fee on your investment portfolio might not sound like much, but over 30 years it can consume a large chunk of your potential earnings. It's crucial to understand and minimize these costs to maximize your investment growth. Mistake number 6, neglecting taxes. Imagine you get a new job with a great salary, but you forget to account for taxes coming out of your paycheck. When tax time comes around, you might be surprised at how much you owe because you didn't plan for it. Similarly, in investing, not considering the tax implications can really cut into your profits. Different types of investments are taxed differently. For example, short-term capital gains on investments held less than a year are taxed at a higher rate than long-term capital gains. If you're not careful, the tax bill could eat up a significant portion of what you've earned. It's important to understand these tax rules and to consider tax-efficient investments like Roth IRAs or 401ks, where you can grow your money tax-free or defer taxes until retirement. Mistake number 7, investing. Without a clear goal, imagine setting out on a road trip without a destination in mind. You might enjoy the scenery for a while, but soon you'd likely feel lost and waste fuel driving aimlessly. Similarly, investing without a clear goal is like navigating without a map. Without specific objectives, it's difficult to determine the right financial products, amount to invest, and strategies to employ, which often leads to misaligned investments that don't meet your actual needs or timelines. For example, if your goal is to save for retirement, you would likely choose a different investment strategy than if you're saving for a short-term goal like buying a car. Retirement saving typically involves a long-term strategy focused on growth and includes investing in stocks and mutual funds that may fluctuate more in the short term, but grow significantly over decades. Conversely, a short-term investment goal requires a more conservative approach, prioritizing capital preservation over growth, possibly opting for bonds or high-yield savings accounts. Setting a clear goal before investing not only guides your investment choices, but also helps measure your progress, making adjustments as needed and keeps you motivated. It ensures that every dollar you invest is working towards something important, reducing the risk of impulsive or inappropriate investments. Mistake number 8, lack of consistency. Imagine trying to build a muscle by going to the gym only once a month. You wouldn't see much progress, right? Investing regularly is like working out consistently. It's crucial for building your financial strength. Many beginners make the mistake of investing sporadically, putting money in when they happen to have extra cash or when the market seems favorable. This approach can lead to missed opportunities and does not leverage the power of compound interest effectively. By investing a fixed amount regularly, say monthly, through an automatic investment plan, you benefit from dollar cost averaging, where you buy more shares when prices are low and fewer when prices are high. This strategy can smooth out the average cost per share over time, potentially leading to better returns and helping you grow your investment steadily. Mistake number 9, overlooking the need for professional advice. Think of trying to fix a car's engine without any mechanical knowledge. You might end up doing more harm than good. Investing can be similar. While it's possible to manage your investments on your own, professional financial advice can be invaluable, especially when dealing with complex situations or large amounts of money. Many beginners overlook the need for professional advice because they want to save on fees or believe they can do it all themselves. However, a good financial advisor can help you create a tailored investment strategy, avoid common pitfalls, and navigate complicated tax laws or retirement planning. They can also provide objective insights during market fluctuations, helping you make informed decisions rather than emotional ones. For those unsure about where to start, seeking professional advice can be a wise investment in itself. Mistake number 10, misunderstanding or risk. Imagine going on a roller coaster ride thinking it's just a slow, steady train ride around the park. You'd be in for a shocking surprise when the ride starts with twists and drops. This is similar to investing without properly understanding the risks involved. Many beginners enter the stock market expecting high returns without recognizing the potential for high risk. For instance, investing heavily in a single volatile stock because you expect it to skyrocket can lead to significant losses if the market takes a downturn. Risk in investing isn't just about the potential to lose money, it's about how changes in the market can affect your investment. Different types of investments come with different levels of risk and potential return. Stocks, for example, are generally riskier than bonds, but they also offer the potential for higher returns. Misunderstanding or underestimating this risk can lead to choices that don't match your actual risk tolerance or financial goals. To manage risk effectively, it's important to assess your own risk tolerance, how much volatility you can comfortably handle, and ensure your investment portfolio reflects that. Diversification, or spreading your investments across various asset types, can also help manage risk by not putting all your financial eggs in one basket. That wraps up our discussion on the top investing mistakes beginners often make. Remember, understanding these pitfalls is your first step towards successful investing. Have you ever fallen into one of these traps, or do you have other tips to share? Let us know in the comments below. We'd love to hear about your experiences. And if you found this video helpful, don't forget to hit the like button and subscribe to our channel for more insightful financial advice. Your support helps us create content that empowers you on your journey to financial freedom. So, subscribe now and never miss out on our latest tips and tricks. Happy investing!